Hey, this is Chris, and in this video I'm going to be sharing why I believe your financial advisor might not be recommending ETFs. And it's something that's quite close to me because for the last 7 years at Stockspot, we've been exclusively recommending ETFs. We don't think investors really need anything else in their portfolios, and it really confuses me to see so many advisors out there still recommending other more complicated and more expensive strategies. But having met a few of these people and seen their recommendations, I've really put it down to one of 3 reasons why financial advisors still don't recommend ETFs in a lot of cases. And the first one is overconfidence. Now, this overconfidence bias or overconfidence effect is something that's been pretty well established in studies, which shows that a person's subjective confidence in their own ability tends to be much higher than their objective accuracy of those judgments. And we see this a lot when it comes to investing, both with amateurs and unfortunately with advisors and professionals as well. A lot of advisors, in my opinion, overestimate their ability to correctly identify winning stocks, to correctly identify when the right time to buy the market is, or to pick fund managers that are going to be successful in the future, not just ones that have been successful in the past. Now, we know from the data and evidence that all of these are extremely difficult to do, even for professional advisors or stockbrokers. Only 15% of fund managers have beaten the market over the last 30 years, and the chance of correctly identifying these in advance is very difficult. 2/3 of shares actually perform poorly or worse than the index over the long run, and only 4 to 6% of shares drive all of the market returns. And again, we know it's quite difficult to correctly identify these in advance, and the small handful of people that can consistently do it are generally very wealthy already and managing their own money or hedge funds and probably not advising retail clients. And then finally, most people can't correctly identify when's the right time to time their entry in and out of the markets. Although there's a lot of commentators that will speculate as to when markets are cheap or expensive, there's no evidence to suggest that advisors are any better at random luck in timing entry, which is why a buy and hold approach usually works better. So overconfidence is something I tend to see a lot in the industry. A lot of people take that overconfidence as knowledge or expertise, but sadly, after a few years of seeing a financial advisor's performance, it's usually quite obvious that there was a level of overconfidence there. The best way to test this with your financial advisor, of course, is to ask to see their track record for the last 5 or 10 years and compare that to a simple index fund and ask for them to explain why there were differences. So the second reason I think your financial advisor isn't recommending ETFs is a lack of awareness around all of this research that has been done around index investing versus active investing. It surprises me, but there's still a lot of advisors out there that either due to who they're employed by or for some other reason simply aren't aware of all of this information. They don't know that most stocks actually underperform. They don't know that most fund managers underperform, and they don't know that a buy and hold approach almost always does better than trying to time in and out of markets. So just simply a lack of understanding and awareness of the hard data is another reason why your financial advisor may not be recommending index investing rather than active investing. And the final one, which for me is the most sad, is a need to justify high fees. So a lot of financial advisors, particularly in the high net worth space and advising, family offices or people with a lot more money, feel like they need to explain more complex strategies or give access to more funky investments like hedge funds or alternatives in order to justify their own costs. And this, in my mind, is something that's going to take a while to change because I think a lot of advisors need to reframe where they can add value versus where they can't add value. And picking stocks, picking fund managers, or timing the market are objectively areas where financial advisors aren't able to consistently add value. However, there are ways that they can add value. And a valid question you might be asking is, if you should just be investing in a bunch of index ETFs, why do I not need an advisor? Why do I need an advisor at all? And it's a great question, and one I've actually answered in a separate video, which I'll put a link to below in the comment section. But there are a few reasons why it's still worth using an advisor, even if they're just recommending low-cost index funds. The few reasons why it's still worth using an advisor are, one, they're going to help you get the right asset allocation for your personal circumstances and goals, and make sure you're in the best low-cost products, because there are hundreds of them out there. There's over 200 ETFs listed on the market now, and a good advisor will be able to pick the right products for your personal circumstances. The next reason is an advisor can help keep your portfolio aligned with your goals over time, so making sure it's rebalanced in the right way and at the right times to keep risk consistent with what it should be for you. And then finally, and I think most importantly, one of the areas an advisor can add value is to keep you on the straight and steady, keep you invested when you're tempted to do something else. So when you're tempted to sell when markets fall, a good advisor will be encouraging you to stay invested because of your time horizon and because markets are likely to recover over that time. And equally, when you're tempted to dial up the risk, invest into more speculative assets at the peak of a market boom, a good advisor will be tempering your expectations and explaining to you that's probably not the right thing to do and keeping you, again, invested into low-cost index funds. So there are great behavioral reasons why an advisor can add value. While I think some advisors still unfortunately see ETFs and index funds as competition to their business, in reality, I think they're just fantastic tools that all advisors should be using in order to help their clients achieve better investing outcomes.